Welcome everybody to the 40 Finance channel. My name's Jeff Beers, and today I've picked out 3 stocks that look like great value buys on paper with low PEs, and we're going to walk through them a little bit and find out, are these value traps? So you hear the word value trap stock a little bit here and there in stock market commentary. Traders look just at low PEs for stocks and they get excited and they think it's a good value, but hidden behind the low PE is sometimes signs of trouble in a company. So that's what we're going to do today. We're going to take 3 stocks that on paper look like great values, but we're going to find out if they are value traps. Let's jump in. All right, first on our board today is Micron. So Micron, which is a semiconductor chip company, and chips were very strong across the board last year. If you looked at any of the sort of Intels and Nvidias, all those things, they were riding sky high well into October, and then suddenly there was little portions of the economy that collapsed on them a little bit, right? So beyond the China trade, which would impact a company like this, you also had numbers coming in from Apple that just said like, hey, like phone sales are down. You had companies that sell computers say their numbers are down. Customers just were not replacing their current gadgets. And so that kind of slowly weighed on the chip industry. And you see that performance here in Micron, whose high was upwards of $58 in the fall, and now we are down to $33.25. Now, in that number at $33.25, you have a current PE ratio of 3.03. That's their current PE ratio. That jumps a little bit to 7.79 in the forward PE, but overall, you got to say to yourself, wow, I can really get in on some low-cost earnings with a company like Micron. They've been in business for a while. They've, maybe chips are down now, but it might be a boom over the next 12 months. Well, let's take a look at a couple things, because Micron is one example of what I would say is a value trap stock. Okay, so a couple things to look at with Micron, and this is from Bloomberg. This is their quarterly income statement and balance sheet, and this is where a real quick assessment can show you that might be better to wait on Micron. So on the income statement side, you see the black bar is revenue, blue is net income, and pink is the profit margin. You see Q3 of 2018, everything was up, profit margin, income. This progresses down to Q1 2019, which is the last one that they had in the books for this graph. And we see a pretty significant dip from that lack of demand for new chips. So things are not looking very good from the past 2 quarters in terms of Micron selling more things, right? And their profit margin has went down quite a bit on top of it. So definitely concerning there. And then when you go to the bottom graph where we're looking at our balance sheet, you have black is assets, blue is liabilities, but most importantly is this red line, which is debt to assets. And you see for Micron, it's been a story where all of a sudden their debt has spiked to the same level of assets. It's not a really strong position to be, and it could be short term, and that's okay, and you could do a lot more research into the company. But from an eyeball perspective, if I was on the fence and saying, hey, Micron, a PE of 3, should I jump in? I would probably look at these charts myself and say, I'm gonna wait. I'm gonna wait to see if they can turn the ship around a little bit, because the one thing about stocks that go down and tank, like Micron's doing a little bit right now, is you'll sort of see that curve in performance, right? So maybe we get to Q3 and you'll see Micron starts ticking up the back up a little bit. So if you're really interested in Micron, I would say to hold, but to put it in your watch list, stare at it every day, get a feel for its performance, and when you start to see those ticks going back up, go back into the financials, see how each quarter's been. If you see improvement, that might be the time to buy into Micron. Okay, looking at the tip rank dashboard like we often do here, the best performing analysts, there's actually 16 of them from Micron. They have 4 holds, 2 sells, and 10 buys. And the upside right now in tip ranks, they're saying, hey, a median view from analysts is $44 over the next 12 months, which is great. You got a high of 60 and a low ball of $28. So when you see this, again, you're probably excited. And I think that these are the best performing analysts. I look at this stuff all the time with tip ranks, and it's a good sign. I don't think, though, you need to buy in today to try to capture this 32% upside. This is projected over the next 12 months, and all it says to me is analysts are confident that the company can get it together at some point over the next 12 months. So no reason for you to buy today. Ride the pine, see if they actually deliver on those concepts, and then jump in. All right, next stock on the list today is Caterpillar. So CAT. And Caterpillar right now has taken some of their own lumps, mainly because of economic concerns regarding construction and housing. China also is a problem because China buys a ton of construction equipment from both John Deere and Caterpillar. So Caterpillar is in a spot right now where I think expectations have been muted, but it doesn't necessarily mean that the company is in a bad spot, and we'll look at that here in a second. You got a PE right now of 12.45. The forward PE drops to 10.28, so that's one thing that I always kind of look for if I'm buying in, and that is a declining forward PE. So the cost of earnings actually is costing me less in the future, at least in the future models. So that's what we're seeing with Caterpillar. You had a high of 159 back in that same fall time before everything started with China. Now you're down to 133. There's been some more dips along the way. And with Caterpillar, you get a super healthy dividend of 3%. So quite the added bonus to jump into a stock like this. But let's take a look at the financials a little bit. So once again, we have the Bloomberg charts here on the income statement. And you see here on quarterly for Caterpillar, Q4 was a dud across the board. So, and that sort of was the epitome of the China concerns. And it was just an absolute dud. Net income, profit margin, all took a hit. Revenue, though, held pat. So that's a good sign, right? It was just that the profit margins dipped. Now into Q1 2019, you're actually looking from a profit margin standpoint and a net income standpoint, which is the blue line. Caterpillar's getting right back up to where they were this same time last year. So a very good sign because we know where their stock price was at this time last year. On the balance sheet graph, it is up a little bit here in 2019, but riding about flat with 2018. So different from Micron, we're not seeing the debt to assets level explode, right? We're not seeing debt to assets start to take over the company where there's more debt than assets. We're seeing a pattern that's holding steady. So we're saying, okay, it doesn't appear on two very quick charts that there is a bad fundamentals behind the company. You saw a little bit on profit margin in Q4, but you see that bounced back immediately in Q1. So some positive signs in that regard. It does look like a company that had a bad Q4, but it looks also like they have bounced back, which is exactly what we want to see when we're investors, is companies that it's fine. They took a hit, their price is down. Now they might be creeping. We also know the backstory with Caterpillar, and that is that the China trade talks will likely shake out some point over the next 6 months. We don't know when that's going to be. It's really hard to speculate, but we know that when it does happen, Caterpillar's world gets a lot better. All right, so looking at the Tip Ranks dashboard, and with Caterpillar, we got 7 analysts, we got 4 buys, 3 holds, no sells. So definitely a little different story than we saw with Micron. You got a high of 172. The median price target for analysts is 155.75. So hey, that's a 16% upside that they're projecting over the next 12 months. And the low ball for the analysts is at 146. So hey, let's just say that this median upside plays out over the next 12 months. I think that that's very possible. You got a 16% return plus, don't forget that 3% dividend. So Caterpillar, I think, is not a value trap. I think it's a good place to put your money if you're interested in that industry. And I look for a recovery over the next 12 months. All right, last stock on the list for today is CBS Corporation. So you probably know CBS from CBS Sports, CBS Sports, the Masters Tournament, 60 Minutes, Final Four, all those things. And that's just a small part of this media conglomerate. And I think what you're seeing with these media stocks in particular, where it's a little bit risky, is everybody's consolidating, selling pieces. You don't know who's going to go where. So I thought it'd be an interesting stock to look at. It also comes with a P/E ratio currently of 6.3, so a pretty interesting number. The forward PE jumps ever so slightly to 7.79, so for me that's an indicator that earnings are getting just a touch more expensive, but not really absurd, right? A PE of 7 or 8 is still a good place to be. Dividend on this one, 1.42%. The high over the last 52 weeks was about $60 for CBS. So what we want to see on the chart over here is that it has taken a little bit of a dip, particularly from fall. It is, though, starting to take some steps back up, right? So that's one of the things, is the company making a recovery? So let's look at the financials. Okay, so looking at CBS on the Bloomberg charts, on the income statement, again, this pink bar, profit margin, revenue, net income, all 3 categories have went up in a very strong sense in Q1. So coming off the Q3, Q4 low points for profit margin, now you've exploded into Q1. Net income's exploded, so very healthy sign there. On the balance sheet, you see the debt to assets here was very high, probably from an acquisition. It's come down a step over in Q3, Q4, and now it's dropping absolutely to lows over the past year. So really strong place right now for CBS. So as far as CBS goes, I'd say the value trap test, if you will, comes back negative. I think that there's something here. We know CBS is a strong brand by itself. You got a low PE, you got fundamentals that are improving, so I think it's worth a look. Okay, and on the Tip Ranks analyst side, we have 5 analysts who look at CBS right now. You got 4 buys, 1 hold. The median price target is $63.80, which is a 23% upside. That's projected over the next 12 months. You got a high bar of 71 from one analyst and a low of 58. So all in all, the analysts are kind of agreeing with us here. 4 buys, 1 hold. They're saying, look, there might be something to this CBS thing. If you're looking at media stocks and you're trying to figure out which ones to look at, maybe you don't like Netflix from a PE standpoint. Maybe you don't like Disney because it's, fragmented across many different industries. CBS might be a play if you believe the next generation of media circles around some of CBS's properties. It could be a very good play. So take a look if you're interested. All right, guys, so those are 3 stocks that look like great values on the outside. They all had low PEs, right? Then we dug a little bit deeper to try to figure out, are any of them value traps? And I think from what we saw, you know, Caterpillar looks pretty strong. CBS looks pretty strong from the value standpoint. But Micron, I would say let's hold our horses a little bit and wait for that company to show some growth forward before we jump into a stock like that. Hope you guys enjoyed this. Please hit the like button, share it with your friends. I really appreciate your support. We'll see you on the next video.